I'm going to start this. Okay, hello everyone. I'd like to welcome you to the fourth NAP On Air webinar series on behalf of the NAP team. My name is MIKAEL. For those new to NAP On Air, our webinars cover a range of topics presenting our strategic partners, giving insight, tips, and advice on digitalizing the ergo logistics, pointing out the challenges and opportunities, and getting us ready for the future. Today, we will be hosting NAP partner Logisyn, presenting insights and trends in the merger and acquisition market. As we all know, due to COVID, business owners and managers are looking for ways to thrive or survive. One of many options available is to either buy or sell a business. This webinar will focus on recent mid-market logistics merger and acquisition trends in the freight forwarding and 3PL space, and how they affect business buyers and sellers. Presenting Mr. MIKAEL OLESEN. Hello, MIKAEL.
Hello.
MIKAEL is a managing director at Logisyn Advisors, mid-market M&A leader with international freight forwarding and logistics domain expertise. He began his career in freight forwarding in the early 90s in Denmark. He has worked extensively with partners around the world, especially Europe and Asia, and understands cultural differences across continents, countries, and companies. Since 2017, MIKAEL has been working in the M&A and executive recruiting space, servicing top 5 global 3PLs, as well as a large number of small and medium-sized enterprises. On our panel, NAP CEO and founder, Mr. Christos Spyrou, you all know him, and NAP Chairman, Mr. Peter Whitfield, with a long career in international freight forwarding and logistics industry, and is now consulting various organizations. Hello, Peter.
Good morning.
Hello, Christos. So some housekeeping about the webinar. It will last about an hour. There will be the first part with the presentation as on the agenda. And on the second part, Q&A session, you can submit your questions in the Q&A section at the bottom of your Zoom window. And Mrs. Jelena Babic, who you all know, she's our network business development manager. She will be gathering all the questions and asking our panelists to answer, and we will have an interaction with Christos and Peter. And of course, MIKAEL. If you come up with more questions and suggestions after the webinar, please feel free to email us. The webinar is being recorded right now, and we'll be sending our members a summary with a link to the recorded webinar and all the important points. For your information, you can find previous webinars on the NAP YouTube channel as well. So please, MIKAEL, we are welcoming you to the stage.
Thank you very much, MIKAEL. And good morning to everyone. Good afternoon, good evening, depending on where you are. I'm in Chicago right now, so the sun is just getting up here. Thank you for inviting us today and for having us and allowing me and Logisyn to give a little presentation about how we see the current M&A market and what's going on in that space of our industry. And hopefully this will give an opportunity for the Neutral Air Partner members to gain a little insight into what's happening here during these unprecedented times. So with that, I'll try to share my screen here, my presentation. Okay. So hopefully you can see that now.
Yes, we can.
Great. So just one quick thing before we get started, I would like to acknowledge that actually today is Veterans Day in the US. So I'd like to send a big thank you out to all the men and women who have served in our military, and some of you might be on this call today or listening in later. So thank you to all of you. A little bit of legal stuff, our regular disclaimer. Basically, for this presentation, Logisyn makes no express or implied representations or warranties as to the accuracy or completeness of the information contained or referred to herein. Logisyn expressly disclaims any and all liability which may be based on such information, errors therein, or omissions therefrom. So we got that done. A little bit about us, about Logisyn. We are an M&A advisory company, which very basically means that we help companies that either want to exit and sell their companies, or who want to buy other companies and grow through acquisitions as part of their strategies. So it's our job to find the right buyers and the right sellers. So in essence, you can say we are kind of a matchmaker in that we find the perfect strategic and cultural partners and the cultural fit. We work exclusively within the logistics industry. All of our managers come from the logistics industry and have a background there, so we understand the space very well. We have worked there and we speak the same language as our clients. We have combined, I think now more than 200 years of experience between us. We have handled over 230 deals combined, and our credibility, our vast network, our industry experience, and our impeccable integrity is part of what distinguishes Logisyn as the leader in logistics M&A. This is our management team. You may know some of these faces here. We have a few industry veterans among us. And again, everyone comes from the industry and has extensive logistics industry experience. A little bit about myself. I have been in the industry for almost 30 years. Started back in the early 90s in Denmark, working for a company by the name of Samson Transport, which some of you might remember. It later became part of the DSV group. I moved to the US in '97 on a 3-year contract, forgot to return to Denmark, and I'm still here. I've worked on the West Coast in Los Angeles. I worked in the Midwest in Chicago, worked on the East Coast for many years in New York and New Jersey, and I'm now back in the Midwest working in Chicago, just north of Chicago. I have since Samson Transport switched to another company, Lehman USA, and my last job within the corporate world, if you will, was as CEO of Lehman in the USA. Since 2017, I've been involved in consulting, mainly on the M&A side, and also partly on executive recruiting. And I've been dealing with all types of companies, small companies, mid-sized companies, all the way up to top 5 global 3PLs. So what makes us different as Logisyn advisors compared to other companies? We are very operation centric. We can identify with the companies and what they are going through on an operational level. We are, as I mentioned, sector focused. We work only within logistics. as opposed to many other M&A advisors who work in several industries, we have decided only to focus on the industry that we know, which is logistics. In everything we do with our clients, our managers and our C-level executives are involved, and we have a very flexible business model where we can tailor our solutions directly to the individual client. So it's not a one-size-fits-all. We actually develop specific strategies for each of our clients. We are a member of various industry organizations, such as NAP, of course, and we feel that this helps us understand what moves the market and what's going on in the market, whether we're dealing with transportation, brokerage, freight forwarding, NVOCCs, e-commerce fulfillment, and of course, transportation technology as well. We deal with all segments of logistics. And you will typically see us at all the different trade shows, obviously not right now, maybe online, but we look forward to getting back to seeing everyone in person. What do we currently see in the transportation industry, and what challenges do we observe? So we see a rising infrastructure cost, a large part of that due to technology, security, network expansion. We see an increase for many years in regulatory compliance that has been going on, not least within the air freight space, of course, and especially since 9/11. We see more sophisticated shippers out there, and an increase in general expectations to the 3PLs and the freight forwarders. And we also notice an influx of integrators, and that is, of course, partly because the market is very fragmented. Looking at the process for mergers and acquisition, there is very simplistic, a three-step process. And this is sell side here on this slide. And the first stage is a preparation stage. Then we go into a marketing and negotiation stage, and of course, ending up with closing the transaction. And we are a little different. This is sort of the model that everybody follows. We are a little different, we believe, in that we are very close with our clients, and being former operators, we understand deep down our clients' businesses and how they operate, as opposed to the more generalists and bankers that are working in multiple industries. And regardless of the structure, these three core pillars will always be part of driving the value of a company. We look at the operational strength of the company, anything from the management team to service offering, technology, the structure of assets, and the capabilities of the staff. On the strategic side, what is the market share? What does the competition look like? Is there brand recognition? On the financial side, of course, very important. We look at the historical trends, and we look also at the forecasts and what the company is expecting going forward, and that has become even more important during these COVID times and more uncertainty in the market. Some of the value drivers. that we typically look at, and these are things to take into consideration when formulating a strategy and to keep in mind for the long-term preparation. And I say long-term because you don't want to just wake up one day and say, okay, I think I'm going to sell my company. You really want to plan for the long term and have these things in mind. And we look at quantitative factors, qualitative factors, and the process factors. So for instance, revenue growth and the quality of the revenue is something we look closely at. EBITDA margins, of course. We look at market positions, market growth, technology. And in the process, we look at how is the current market environment, what does the buyer universe look like, and what is currently driving the market. So all these things are key things that a seller would want to keep an eye on and a key part of their long-term preparation. So talking about EBITDA multiples, are they overemphasized? We believe that they sometimes are, but it's really also a matter of what goes into an enterprise valuation. So we look at typically 3 to 5 years of historical financial averages. We look at 3 years of projections, and we also look at what we call trailing 12 months, or the last 12 months of performance. Scale and size is important, and it creates an accelerator and a multiplier effect. The niche that you might operate in could be a differentiator, and high barrier to entry could be attractive for a buyer and could even effectively become your value proposition. Growth opportunities are, of course, also very important for any buyer to become excited about the opportunity. And consistency of performance is also key. We do not like to see a hockey stick performance. We like to see consistency. It typically leads to better valuation as it equals lower risk to the buyer, and it'll most likely also result in a better deal structure and capital structure. In the mid-market business environment where we work a lot, we still see that it is a very entrepreneurial environment. Many original business owners are still operating. We see them many times more traditional than digital, and COVID-19 has certainly exposed some businesses that have been struggling a little bit in that area. Digitalization is no longer optional. It is necessary to run your business, both from a customer perspective, but now also from just necessary to even survive with people working from home. We see that companies sometimes lack a bit of strategic focus, more focus on the daily operations, and important to keep the overall strategy in check as well. Scalability, where is the company headed? Is it going in the right direction? And planning ahead. We always advise our clients to plan ahead for an exit strategy and do that early. So looking at the current freight landscape, we see it being very strong. Strong demand for truckload, especially here in the US, ocean freight and air freight, as the members here will, of course, know very well. And we believe we're basically back to pre-pandemic levels in that area. Container shortages getting very intense, which has an immediate effect on the costs. We see strong gross margins, and with brokers and asset-based companies, and actually also with freight forwarders and NVOCCs. We see a strong and progressive valuation still. We don't see any COVID discounts out there in terms of multiples. We do, however, see that the capital structure is being impacted, and the deal structure with less cash at closing, and we see more different earnout models. E-commerce, B2C getting stronger. E-commerce and fulfillment, of course, last mile, etc. These are all red hot at the moment. We still see a little bit of a broken supply chain. There's some overhang from the production delays because of the pandemic. As mentioned, we see an increased digital commerce. E-commerce spending has gone up exponentially. We see companies increasing in this area and on the digital spending, and generally embracing new technology. Heavy pressure on last mile and the final mile sector. And we see market changes in terms of holiday schedules, less globalization, potentially less equality, etc. And an increased digital landscape. And these are really the fundamental changes that are occurring in the market today as we see it, and which are very important for executives, company owners, sellers and buyers to know and to be aware of. So the big question, so what is the impact of COVID-19 on the logistics sector and transportation and freight forwarding in general? We see a strong e-commerce boom. We're looking at, for North America, an 18% compounded annual growth rate, and we expect that to continue and grow exponentially over the coming years. We see an impact to the 3PLs revenue, and we are estimating for 2020 that it'll be in the range of 7 to 10%. Obviously, some companies are doing better than others, all depending on which verticals you're operating in. We have a very fragmented sector in freight forwarding, freight brokerage, e-commerce, last mile, and there's a tendency for the large companies to get even larger, and the fragmentation is getting somewhat deeper. There's some speculation about that the real impact of COVID might still be coming and still get worse before it gets better. There are certain government stimulus packages, and speaking mainly for the US, we have had some payroll protection programs, added unemployment benefits. There's been some direct support of individuals and consumers, and these are tapering off, which could have an impact going down the road and over the coming months. But that said, we do also see a very, very opportunistic M&A landscape. We see lots of good activity in the marketplace. We have more mandates now on both the sell side and buy side compared to Q2 and late spring. Very active market. And there are other factors that might play into this as well. We have some potential changes to capital gains tax in the US, which could bring more sellers to the market. And we see also that inventory is still relatively low, meaning that, and I'm talking inventory of sellers, and that could mean that there's an incentive for sellers to at least test the market right now versus to 2021, where we do expect the market to become more crowded. There's still a lot of market uncertainty, and the market is still very volatile compared to what it would be in a more normal and typical economic environment. There's an enormous amount of dry powder sitting out there, more than $1 trillion waiting to be deployed. And a lot of buyers are chasing deals in the logistics industry. They like logistics, transportation, freight forwarding. It continues to be attractive. It has historically been a good place to be in, with attractive return on investment. We see strong balance sheets with the strategic buyers, which creates activity in the market, and we also notice a trend with the strategic buyers to look at perhaps larger acquisitions than they have done in the past. Valuations are somewhat challenged. However, as I mentioned, we don't see a lot of discounts. We see more of an impact on the actual deal structure with cash on closing and extended earn-out periods. So many times some creativity is required there, and that's one of the places where Logisyn can certainly help. And again, we just see a very opportunistic M&A landscape with great opportunities out there for both buyers and sellers. So what are the strategies for founders and owners? We believe you need to stage, you need to plan ahead. We recommend strongly that you hire an expert advisor such as Logisyn. This will help you to enhance your chances of maximizing your enterprise value and the deal structure. Consistency, very important. Your financial track record, the market opportunities, point your business in the right direction, a sustainable direction, and look for the long-term market opportunities. Growth levers and segments. We believe you need to clearly establish what your growth opportunities are for your business in order to maximize your business potential. You need a good and solid management team. You want to reduce owner dependency. Many times buyers do see a risk if the owner is working in the industry. What happens when that owner leaves the company? Your business model, focus on creating something that's scalable. Buyers like to see that what you have done, what has made you successful, can be transferred to their company and to their organization and can be scaled. And that's, of course, one of the major synergies that they will be looking for. Track your customers, track them like you track your balance sheet. If 20% of your customers are generating 80% of your margins, what are the bottom 20% doing? Are they dragging down your margins? And again, innovation and digitization is key, and it's now more important and more urgent than ever. You can look beyond your core businesses, look for additional synergies, be creative about the deal structure. It is as important as the actual enterprise value, how you structure a deal. In this market, you do need experienced deal makers to help you. You can de-risk your M&A strategy to some extent by trying to force some strategic alliances. That could be great options as well. And last but not least, we do believe that M&A opportunities are typically not found. They are most often developed. And it's all about relationship and trust. And for us at Logisyn, our clients, they trust us to help them and to help deliver on their strategic goals. And lastly here, the process in terms of selling a company, we can do, there are different models here. There's a negotiated deal, which typically involves finding a relatively low number of qualified buyers, maybe 1 to 5 qualified buyers. And then we have a targeted process where we look for more buyers, 20, 40, 60 qualified buyers. It's a broader process. And the final one, the actual broad process, is more of an auction process, which we generally do not get into. Our sweet spot is really the targeted process, which is a blend of strategic and financial buyers, which we identify through our vast network. And as market experts, we know the marketplace and we know how to position your company and to get the best value for our clients. So with that concludes the presentation. I hope we're good on time here. Thank you very much for listening in. My email is on this slide here. Feel free to write that down. I'll put it in the message box here as well. And feel free to contact me directly if you have any additional questions that might not be covered today. We're also always very happy to have a chat over a cup of coffee, even if it might be virtual at this point. So thank you for tuning in, and I will turn it back over to MIKAEL.
Thank you, MIKAEL. And now I will give the stage to Jelena for questions from our members or from our panelists.
Okay, thank you very much, MIKAEL. I will start with a very soft question for a start. Do you expect an increase in M&A activities in 2021 subject to the post-COVID market?
Thank you, Christos. Yes, we do. So we are actually already seeing that now. Q4, things have really been picking up. Q3 actually already, and Q4. And we expect that trend to continue. COVID is, of course, still one of the big ones, but good news out this week about a vaccine. And I personally think that's going to have a big impact on consumer and investor confidence. That's going to accelerate the M&A market in the coming months and next year. And we also, and this is of course what we've been waiting for since March, so it's really going to be a game changer as I see it.
Do you feel is there a panic somewhere in the market that you see the activities, like a panic from potential sellers, that what is going on, like a new era, like new? Do you feel there is a panic out there that increases the M&A activities?
I don't think there's a panic, but I think there's an opportunity definitely to take your company. It's a good time to take your company to market right now. So a good time for sellers and for buyers. Lots of opportunities out there, and our industry is still very, very fragmented. So lots of opportunities still for within the acquisition space. There's another thing also that has been probably a bit of a drag. We've had, as you know, of course, an election going on in the US, which is now finally over, and that always causes some uncertainty. So just by that now being in the past, creates some more certainty in the market, which will also help increase the M&A sector.
Okay, thank you very much.
Yeah.
Could you explain when and how do we prepare to sell our company as international freight and logistic providers?
Well, as I mentioned, there are many different things you need to look at. You really need to, as a seller, take a step back, look at your, your long-term strategic goals, your personal goals, your business goals. Are there things you need to change in advance? Things you can do better to position yourself better? We believe that depending on what kind of strategy you're looking at, whether you're on the buy side or the sell side, you got to be clear on your strategies. Do you want to grow your company through acquisitions or organically? And if you're selling your company, how do you want to do that? Are you looking to potentially retire? Do you want to maybe sell off some of your core business? And there are just so many different options out there which you can take advantage of.
Thank you.
Thank you, MIKAEL. MIKAEL, one more from me. There is, I would say, a kind of a universal assumption that a freight and logistics company, the value of a freight and logistics company is pretty much more or less 4 to 7 times EBIT or EBITDA. I mean, if you look around, everybody speaks about that. I mean, how realistic is that at the current global market based on your experience?
Well, as I mentioned, we don't really see any COVID-related discounts in the market. It has actually stayed, multiples have stayed very stable. 4 to 7 is probably somewhat reasonable. It can go higher, of course, depending on the individual company. And it also depends a lot on the region you're in. So multiples in the US, for instance, compared to Europe tend to be a little bit higher. So I would say for the US, we are right now looking at maybe for freight forwarding companies, probably between 5 to 8. And for larger companies, it can certainly go up from there, even into double digits. And if you're talking a technology company, transportation technology, you can go very, very high. So in general, I would say those multiples are still somewhat of a guideline, but very individual.
And is that an average of the last 5 years of a company, like an average of the numbers of the last 5 years, pretty much, or 3? Where would you put the number?
Yes, so that can be done in different ways, but you certainly look at the last 12 months, the trailing 12 months, and you also look at the previous at least 3 years, and you want to see that consistency in there. And you also very much look toward the future. and see how well have companies done during COVID, how well have they been able to manage the crisis, if you can call it that, and how are they coming out of it? Are they coming out strong? Have they lost business that's not coming back, or is the business coming back? Some companies have come back even stronger, and of course other companies have been struggling more, depending on which verticals they've been operating in. So if you've been in some of those verticals that have been hard hit, I think such as automotive at some point, of course, if you're dealing with trade shows, etc., that are not happening right now, you're taking a hit. Other areas, such as pharmaceutical, have been doing great.
Yeah, thank you very much. No, very clear. Thank you.
Does a non-asset or light asset freight company has advantage over a heavy asset seller candidate?
It depends. If you're looking at most freight forwarding companies, typically are asset light and will look to buy. They're not necessarily interested in buying a lot of assets. That said, we do also see that asset heavy companies, transportation companies, trucking companies are doing really well right now. I would say it depends on which sector you operate in. But for freight forwarders, which I assume is most of NAP's members, of course, typically asset-light companies are what they're looking for. That doesn't mean you can't have a warehouse that you own and a couple of trucks, but asset-light.
Asset-light.
Definitely more attractive in that space.
Clear now. Thank you. Christos?
Yes, and MIKAEL, being in the industry and in the network and speaking with friends and partners, I always hear from some of them that they're looking to drive the revenue. They don't really care about the profit, but they're looking into revenue. So my question is like, how important is that a high revenue business with, I would say, less profit than the market gross profit of the industry, and in which situation they can find a potential buyer, these type of companies, and how important is the revenue at the end?
Yeah, that's a good question, Christos. I would say, of course, primarily we're looking at the bottom line, but not always. Even if you have if you have a declining top line and a declining bottom line, that's a problem. If you have a declining bottom line but your top line is growing, not necessarily a bad thing, because it shows that your company is doing something right. It's attracting new, gaining new business. It's just not, for whatever reason, able to put that to the bottom line. But there could be many reasons for that, and that could be potentially attractive for a buyer to come in and see, okay, we have a company here that's actually growing, and we believe we can come in and help them translate that growth into bottom line numbers. So not necessarily a bad thing if the top line is growing. So something to keep an eye on for sure. But ideally, the bottom line should be following.
Okay, so as long as the bottom line is following, it's not necessarily bad. Actually, it's positive.
Yeah, and it could also, like I said, it could provide, depending again on the specific company, of course. A buyer could look at, okay, we have a company here that bringing that into our system, we know how to take that top line and monetizing that and bring that into a profit that'll hit the bottom line. So many buyers look for these synergies that could come out of an acquisition.
Thank you.
And how important is compliance and accreditation standards in the M&A market?
If you're talking about with with a potential seller. Very, very important, of course, as a buyer. When you purchase a company, if it's a stock deal, you basically buy everything. So whatever has been going on in that company in the past, you're taking that over. If there's skeletons in the closet, those are now yours. And even if you were to do an asset deal, you're not completely immune to that. If something was to happen, you're likely to be dragged into that. So that is very, very important, and of course a big part of the due diligence process that takes place in an acquisition. If you're talking more about within the M&A world, and for us as a company, of course, that's the highest priority for us to be a very ethical company. And we have one of our managing partners is an attorney, and he keeps everything in check in that area. So that's certainly one of our value propositions.
Great, thank you.
Okay. So basically, you're saying, like, before we even start discussing, we need to do the whole housekeeping and have the proper accreditation and compliance and licensing and legal affairs in place, right?
Correct.
Yeah.
Absolutely.
Okay. Another thing, which I think a lot of our members that they hear us now, they have it in their mind as a question. And I'm looking now at NAP. We have, I could mention like more than 13 members that we have, that particularly in the air cargo logistics sectors, there are those type of local heroes. They are top 10 IATA in their own country. They have very good revenues. They're very well known, but very local and independent. However, some of them, not all, they hardly control more than 50% of the business. That means 50% of the business is coming from multiple routed business, from overseas agents, and so on and so on. So in that case, I mean, what is the threat? How does it work when you cannot prove that you control more than 50% of your business?
That's certainly something that's being taken into consideration, and it's a typical scenario because as most companies have partners around the world, unless you have your own offices everywhere. Whatever partners you work with, hopefully it's a two-way street and you're getting some business from them as well. But it's not your business. So if you sell your company, there is a risk, of course, to the buyer that business will disappear, and that will certainly result in somewhat of a discount in terms of the valuation of the company. And again, it goes into also the individual company, and you could, for instance, have a buyer who maybe doesn't have representation in the specific country where the seller has a good relationship and is getting business from their partner. So if you can keep that relationship, that could be a benefit. But I would say most times these are not tied into any kind of contracts. So there's a risk for the buyer that it may fall away. And during due diligence, again, during that process, that's something that'll be explored to see what can be expected to continue after an acquisition and what is likely gonna fade away.
So in a way, you're telling us that it can be an advantage in some cases.
It could in some cases, yeah.
So basically, it makes sense that before, once I decide that I want to sell my company, and it's that type of companies, I need to come to you or a similar organization in order to identify the right buyers for that business. Because correct. I guess if you want to go to Expeditors or DSV, they will tell you right away 50% of valuation is out because we don't need this business, we're going to lose them.
Absolutely, absolutely correct. So if they already have their own office there, of course, not interesting, that business will disappear. Okay. But if not, and if that's an area they would be interested in, and a place where they need representation, it could potentially be a positive.
Okay, so one more on that, and I would like also, because that's a very interesting question, because I guess 50% of the independent freight logistics providers, they pretty much work that way, I would say. You have very few, only some vertical players that they control like 80, 90% of the business. The general cargo players, pretty much they run into that numbers. I would like also to bring Peter into the conversation. I mean, Peter, you sold your company twice, right? That was 10 and 20 years ago.
Right, and Michael, I just wish I knew you way back then. Everything that you've said in your presentation today, Logisyn would have been fantastic for us, but we had to learn as work in progress. But absolutely agree about, particularly on this 50-50 piece of business. Part of our strategy when we were looking to, in the longer term, to sell the business was to try and position ourselves in the markets that we felt were vital to that success of the sale. So, for example, we started the business in Australia, then we bought a business in New Zealand, and then we started operating in the US. And so we had end-to-end between the US and South Pacific, so we controlled both ends of that business. And then we did the same in China. So very much an important piece. And I could see that it would be difficult for somebody who relied just on the business they controlled in the origin market. So, you know, definitely a real part of the strategy going forward. And the other thing I just wanted to say was just how important in your presentation the value drivers are in the whole process. And you know what we tried to do, even though we were a private company, smallish private company, we always tried to maintain the financial side of our business as if we were a public company. You know, I insisted on annual audits and all of those things that people sometimes shy away from. But in terms of getting your business ready for sale, to actually have that to rely on in terms of your new or potential buyers was fantastic. So, yeah, I could go on forever talking about your presentation because so many of the pieces are just so key to the success of a good sale. And we had a couple of good sales, but we had to learn a lot of that stuff ourselves. So,
right.
Anyway.
Yeah. Thank you, Peter. Just to comment on Peter, so thank you, Peter, for those comments. And I think you're exactly right. So, you know, just by making sure that you line up your company in the most professional way in advance is going to come back tenfold when you take your company to market, and especially when you later on go into due diligence. And we're talking a lot about quality of earnings and looking into and verifying that the numbers that have been presented by a seller, that they actually hold up and they are solid. So very important. Yeah.
Michael, would you ever recommend to that type of organization, local, independent, very good numbers, revenue, profits, EBIT, you name it, but still control only 50%? Would you ever recommend that they go, before they go into the market, to the M&A market, would you recommend that they buy a local hero, a small vertical, or another company which they have, you know, a healthy 100% local client base in order to increase, I would say, the numbers, or their, I would say, to get more attracted from potential buyers?
You mean buying a company locally, where okay. Yeah, certainly. I mean, if you can acquire companies that'll strengthen your company in any way, will of course help position you even better. Keeping in mind, of course, that there will be typically a bit of time before you have that company fully integrated and before you see the full impact of that acquisition. But definitely, if that's part of your strategy before you want to take your company to market, to grow it to a certain size where you feel that you're better positioned to take it to market, that could be a good strategy. And we see that sometimes also in terms of companies that work in specific verticals that they want to diversify, which is another very important thing. You want to be diversified, at least to some extent, and not just rely on certain verticals. And again, going back to the ones that are not exactly recession proof, as we have seen just now, some are very vulnerable. And then you have other verticals that are pretty much recession proof, as we see in the pharma industry, pharmaceutical companies. So if you can strengthen your portfolio of verticals and customers that way, that could certainly be a good strategy up front.
That was actually that was about to be my next question. If you see pre-COVID, those type of vertical experts, particularly some critical service providers, could be special events logistics or automotive, pharma, clinical trials, aerospace, ships in transit. They had the kind of a name, perishable for Worders. Like, I mean, even recently, like a few years back, they sold their company for a lot of money to big boys. But post-COVID, that started to change. And then you see a lot of companies realize that, it's not really working. I have to diversify my products. Is that correct?
Yes, absolutely. So I think nobody was expecting this, right? Everybody talked about it, but and now it came. So I think that was a rude awakening for a lot of companies, that when the times are good and you are in a vertical that's attractive, that's great. But if that vertical is very vulnerable to changes in the environment, like we've seen with the pandemic, which is of course, very, very unprecedented, then it's time to take a look at your strategy and figure out, okay, should I perhaps look at diversifying going forward? And we do see that a lot.
So your advice to a healthy, small and medium-sized provider that I would say they're more focused into automotive or to aerospace, your advice would be diversify, like try to extend your products, become a bit more general, diversify your business.
Yes, again, depending on the long-term strategy, right? So because it's gonna bounce back, of course. But there could be other things coming up down the road. So again, buyers look at risk, and I think now there are new risk factors that were perhaps not so much in the forefront just 1 year ago, and now they are. So positioning yourself in a stronger in terms of being more diversified is certainly something that'll benefit you when you do want to take your company to market.
And you also mentioned before in your presentation, you mentioned about technology adoption. That is very important for the potential buyer. I mean, what exactly do you mean? Technology, you mean like TMS systems, like digital portals? I mean, what exactly do I have to do, let's say, for example, in order to reach that level that you believe, okay, I'm in a good, I would say, position as far as technology concerns?
Yeah, that's a little bit of a different area, of course, but I do believe, the expectations have changed, right? So whereas before, if customers might be okay with some kind of visibility, and there was, it would be great if you had something that was automated and your customers could automatically just track and trace their shipments. Now, that's not something that's that's an added service. It's expected, right? So, and that continues, and the automation of bookings, etc., not necessarily having to be in touch with your freight forwarder at all times, but can run it through systems that are directly linked between the shippers and the freight forwarders is what we see more and more. And at the same time, of course, being able to have your staff work remotely was another thing where some companies were struggling, especially in the beginning, because they didn't have that capability. And of course now they do, in order just to survive. So it's both internal and external.
Okay, thank you very much.
I have another question. Yes, are there any standard contract terms that the management of the buyer has to stay for a certain period of time under contract before the acquisition takes place?
So the management, so you mean the management of the seller, probably, right?
Yes. Yes.
Yeah. So there's really no standard, but of course you want to see as a buyer when you acquire a company that you do get everything transferred over, customers, and many times also staff, because the buyer is many times looking for the staff as a big part of the assets, and want to keep the staff, and many times also the management, depending on many things, such as, of course, the geographical location. And if this is a new area for the buyer, they will need local management. So they're certainly looking for that, not just short term, but it could be long term. So at least during the integration, companies are looking for management to stay and make sure that the transition goes well. But key management will, in most cases, also get an opportunity to, if they want to, unless of course they're retiring and want to go lie on the beach, invited to stay on board and can take maybe new roles in many times business development or other executive roles in the new company.
But is there any certain period of time that management has to stay with
There's nothing specific, but I would say in general at least a year or two. And then of course you have clauses put in place that whoever sells a company can't just go out and start a new company, and that'll be a direct competitor. So that's typically part of an acquisition deal. But there's nothing set in stone. It comes down to the individual deal.
So it's up to buyer and seller on their agreement.
Yes.
Thank you.
I think there's also, I'm sorry, Yelena. Just
yes, continue, please. Yes.
There is also kind of a joke in the industry that some buyers, I mean, the way they, on the contract, the way they propose to the management to stay for 3 or 4 or 5 years and to prove that the numbers are correct, pretty much there's a joke that you work, actually, they buy your company with your own money because you're staying in the company for 1, for 2nd, for 3rd year. So pretty much they buy 25% every year. And at the end, with your own profits, they buy your company. Is it something that is really happening, or it's just a kind of a joke out there in the market?
Yeah, no, that's correct. So if I understand you correctly, Christos, depending on the deal structure. So if you're dealing with an earnout, so you will have the buyer will pay some cash up front, and there'll be an earnout period. And during this period, let's say it's maybe a 3-year period, earnout period. During that period, the seller will have to perform according to the expectations and what has been agreed in the purchase agreement. And you can say, of course, there's an incentive there for the seller to still remain with the company in order to have direct influence on the results, which will guarantee that they actually get paid what was initially agreed, and that the profitability of the company stays at that level where they will get paid the purchase price that was agreed upon.
Okay.
Did that answer your question?
Absolutely, yes.
Okay.
But how often is that, based on your experience?
That is quite often. Quite often.
Quite often.
Yes, and especially, as I mentioned earlier, especially right now where we see a bit of a change in deal structure, trending toward longer earnout periods just because of the market uncertainty.
Just
Thank you,
on that issue, with 2 sales, the first one was an absolute insistence that the management contract was signed and was part of the deal. On the second one, it was corporate policy of the acquiring company that the CEO and founder of the business actually didn't stay for long. They wanted to move some of the ingrained culture, if you like, out so that they could then bring their own culture into the business. So, it just depends. It depends on the 2 companies, just how they have a particular style or not. But certainly in an earnout situation, you pretty much got to stay there to make sure that it works.
Very true.
Yelena, on you.
Yes, now we have questions from our members. Okay, just to continue with the subject, from John Beck, is there a size after which MBO is not possible anymore and that the owner has to search for outside M&A? Or are there ways to succeed at MBO knowing that a certain value the buyer or buyers might not be able to have enough asset to contract a loan? Alternatively, is there a guideline at which MBOs are not recommended anymore?
NBO as part of the, I'm not sure I quite understand the question, to be honest.
So I'll read again.
Mm-hmm.
Okay, I think you can also click on the questions.
Oh yeah, I see it here. Okay.
Okay. Yes, I am reading for people who can.
The MBO is management buyout, as for John. That's what she means.
Right. Yeah, it's a good question. I would say in terms of a management buyout versus an M&A. I don't think there are any specific guidelines there. It really depends on what the capabilities are of the management team, and in terms of recommending if there's a size, I don't think so. I mean, we've seen companies quite large where there's been a management buyout. I think it also depends a lot of really the owner's strategy and what he would like to see with the company going forward, and maybe being able to position it so that you could actually do a management buyout. But it really comes down also again to the individual situation where the capabilities of the buyers, what are they able to buy, and will that satisfy seller, and over what period are you looking at, which could certainly influence that. So again, the deal structure will play into this a lot also. But it's of course something that we typically see with small and mid-sized companies. When you get into larger companies, it's more unlikely.
And I guess romance is playing a little role over here, right? From the owner that wants to give it like a management buyout. It's more romantic that where he wants to see his or her company when he retires.
Right.
And so on.
Yes, and you're right, and a lot of companies owners would like to see that, of course, and it's certainly also a good way of doing that. But again, it depends on the individual situation there.
Also from John, what are your thoughts also on earnings out as a way to lessen the risk for the buyer?
Well, it's again, we're talking about minimizing the risk for the buyer, of course, and that's really what earnout is about. That you pay some money up front for the company, and then you have an earnout just to protect yourself as a buyer in terms of in case that the company doesn't perform and deliver as well as it was thought. So even after going through typically a long due diligence process, there's still uncertainty, and market conditions play into that, like now when we have COVID, of course, and what's going to happen in the coming years. So the deal structures, as I mentioned earlier, have changed a little bit in terms of longer earnouts and different earnouts, more backloaded deals, as we call it, than perhaps we have seen just 1 or 2 years ago.
Thank you. Next question from our Sam Okro. With less globalization and inward-looking strategies by many countries today, how would this eventually impact global trade and the logistic industry responsible for goods movement during the post-COVID-19 era?
I'm sorry, yeah, I dropped you a little bit there.
Okay. With the less globalization and inward-looking strategies by many countries today, how would this eventually impact global trade and the logistics industry responsible for goods movement during post-COVID-19 era?
Okay, so maybe this is not directly related to M&A, but of course, in some way it is, that if we're talking less globalization, if that's the question here, as I understand it, that will of course change things. So if I look at North America and how things might change here, we're talking about nearshoring, bringing potentially some production back, not all the way to the US, but perhaps to, for instance, Mexico. And of course, that'll change the dynamics of the freight forwarding world and the movement of goods. But if that plays and how that plays in directly to M&A, that's a different question. But I would say within the US, there's certainly a big interest in having a strong inter-America system in place and being well represented both in Canada and in Mexico. And that's probably going to increase.
Okay. Thank you. That's all from me.
Okay. Thank you.
Thank you, Yelena.
Over 15 minutes. Thank you so much.
Thank you, gentlemen. Okay, so thank you, Michael, for the very interesting presentation of Logisyn.
Thank you.
Thank you to all of you watching. Thank you, Yelena and Boris, as always. We hope your questions have been answered. And if you come up with more questions, please feel free to email us. We have been recording this webinar and we will make a post webinar summary. Also, one last thing. Next week, we have 2 webinars for you. Do not miss our 5th NAP On Air special webinar, NAP and TIACA Orientation webinar. It will be Discover TIACA and the benefits of for NAP members on Monday. And then on Wednesday, we will have the next 6th webinar, presenting CargoWise, Mr. Keith Plummer. So stay tuned and save the dates. We will be sending e-newsletters, invitations. Thank you very much for watching.
Thank you
See
very
you
much.
next week.
Bye.
Thank you.
Thank you, Michael.
Bye.
Thank you. Bye-bye.